Presenting on the investment market, Bryce Blanchard, Principal and Executive Director of Investments with Newmark Grubb ACRES. Bryce has been a top investment broker in the industry for 20 years, completing over 400 transactions totaling over $3.3 billion.
Oh, thanks, everybody. So the theme of today's symposium is going up. Kind of a cool theme. I started searching the internet because one of my things in life is I'm a baseball guy. I've been hitting leadoff for the Salt Lake Lugnuts for the last 20 years. So like every good leadoff guy, Kaiser 316 is going to provide me with some walk-up.
I said my money going up, my money going all the way. Price going up. I said my price going up.
Price Realty's going up.
All the way. Money going up. I said my money's
What's going up? Money's going up.
All the way. Price going up. I said my price going up, my price going all the way.
Thank you, Kaiser 316. So what's going up in the Utah investment market? Money's going up, prices are going up. These are all good things. I'm thrilled to be our leadoff speaker this morning. We've got a great group of guys that have put a lot of work into their presentations. And I want to give a thank you to the NAIOP board and all those that have labored over this great event. Angela, fantastic job. Lindsay, it's almost over. You can relax. Let's get you a massage tonight. And maybe a spa day for tomorrow. You've been fantastic. I want to give a shout out to my research and support teams at Newmark who've been fantastic to help me with the data that we've gone through. I see myself as your tour guide this morning, kind of setting the table as a leadoff guy and let the big guys drive me in once I get on base here. So we're going to talk about the investment marketplace. What's going up? Well, for those that know me, I'm a huge basketball fan. Jazz for life, and I'm an Oregonian by nature, so I'm a convert to Utah, and I'm all in with the Jazz. I've been occupying some court. Yes, thank you. Go Jazz. And how about that game last night against the Nuggets? ESPN, Raleigh and I were supposed to be here doing a dress rehearsal. I'm like, Raleigh, let's go over to the game. So we skipped out, so I hope we do okay, because we did not practice last night, but instead we cheered on the fellas, and we were paid off, because that was a fun time. We actually even rode one of those little bikes to our cars back. We got driven. It was cute. We had a little mandate. So the Jazz ticket prices are going up. I'll tell you that much. My season ticket cost went up about 50% in the last 3 years, but I'm going to continue to pay the freight because I'm an NBA junkie and I love rooting for Utah Jazz. We got a special thing going. Let's get into transaction volumes. We had 4 straight years of record-setting transaction volumes in the state of Utah. Every year we kept outdoing ourselves. Last year we were at $2.2 billion in sales. About the time that many of us were like, I don't think it can get any better than it's getting. We threw up $3.18 billion last year. By the way, because I'm short, I can't stay behind the podium. You can't see me. So I'm just going to walk a little bit. That was a 44% increase over 2017's record-setting year. And if we turn back the clock even further, to 2009, the beginning of this expansionary period, you can see sales volumes were only at $290 million. There were 63 deals done across the whole market. That's hard to feed your family when you got the whole brokerage market doing 63 deals. But we're up 10x since 2009. Truly spectacular on volumes. As we break down where has the money been going, anybody that's been watching the market knows how hot, and Raleigh's going to talk more about the multifamily sector. $1.3 billion was spent in Utah multifamily projects last year. Industrial had a very strong showing, $566 million of sale deals. Office and retail were equally impressive. If we compare those volumes over the last few years since 2012, you can see the trend line continues to go up. Now, each of you are going to get a symposium book at the end of this, so rather than me spend too much time on all the graphs, I'm going to refer you back to the write-ups that we all did and the charts that are in there, and try to make a little more compelling points for the oral presentation today. But as you can see, multifamily was up 50% from last year in sales volumes, and industrial tripled the amount of deals that got done in the investment sector. Office just down slightly, but only because there were too few willing sellers. Lots of appetite for office. I took the Clift and the Felt buildings to market. We had 120 confidentiality agreements from all around the country, actually all around the world. Our number 2 place finisher on our final invest was a Saudi fund that was investing in New York, San Francisco, and one other market in the country. Seattle, LA, Houston, Salt Lake City. New York, San Francisco, and Salt Lake City. That's the only place, 3 places they wanted to put their capital. If you ask any sale brokers what was going on, listen, I love getting phone calls and emails saying, Bryce, I've got my fund raised. I'm ready to deploy capital in Utah. Find me some good deals. I got 1031 guys calling me. I've got syndicators with fresh buckets of private high net worth guys. And at some point in time, you start to feel like the DMV. You're like, yeah, you take a number and get in line. There's a lot of people chasing not enough deals. So if we go back to our econ classes, we got too many buyers than sellers. What happens to pricing? Well, again, back to our initial walk-up music. Price is going up. Let's look at sale prices per square foot. And I think it's interesting as we look at 2018 versus 17, there was moderate price per pound growth across each subcategory. Defensible, reasonable, nothing to get too excited about or alarmed about. But I think we got to at least compare price per square foot going back further than just last year. Let's look at it compared to 2014. Now, to give this some context, general inflation, CPI, over this same period of time has been about 7%, okay? So that's the tide that's been slowly rising around us. If we compare the rate of appreciation of commercial real estate as measured by price per square foot, you can see that as a composite, the market's been inflating at 5 times faster than general inflation. Led by industrial, $61 a foot was the deals Kyle was doing in 2014. He's now selling stuff at $103 a foot. Okay? That's a 10x rate of inflation for our industrial pricing. Multifamily, over 50%. Raleigh can tell you how hot that sector is. And then we've got office, has increased its basis from $155 on average to $206 for our marketplace. Even retail, which is a sector that's had some cautionary tail to it, has tripled the rate of inflation. What else is going up? Well, I was thinking about this, and it's been, like I said, I'm a transplant to Utah. I've embraced all things Utah. The Beehive State's become my home for my wife, who's here tonight, this morning, and our 4 kids, and we just love Utah. We're not going anywhere. And neither is the investment capital, because as far as I can tell, we've got this incredible tailwind that keeps pushing our market along. Some of the key facts that investors are looking at is our job growth. We're at 3.3%. Compare that to a national average of 1.7%. That's pretty compelling. You want to buy office buildings, think about that job growth. How about population growth? Nationally, the U.S. inflated its population by 0.7%. We were at 1.9, so actually more than double population growth. And since 2010, our population, which is not just our crazy demographic birth rate anymore, it's in-migration. People are moving here for lifestyle and for business opportunities. Since 2010, we are #1 in the nation. Our population has increased 14%. An interesting point that not everybody looks at is the economic diversity that's here in the Beehive State. The price of oil sneezes and Houston's office market catches a cold, right? Some markets in the country, their real estate markets are tied to certain sectors. In Utah, we've got aerospace and defense, we've got fintech, we've got manufacturing and distribution, outdoor products, we've got advanced materials. We've got this eclectic group of industries that provide us not recession-proof, but recession-resistant demographics and industry clusters. And because of that, we have the #1, what's called Hackman Index score in the country at 96.7%, making us the most economically diverse state in the country. #2 is Missouri, by the way. And accolades continue to come pouring in from people that aren't based here and are not biased. They look at us, groups like U.S. News and World Report said you're the #3 state in the country across these various metrics. And then we've got groups like Forbes that rank the best states for business. They've been doing this since 2006. Utah came in as a silver medalist in 2018, #2, finishing just behind North Carolina on their metrics. North Carolina's finished #1 twice. Virginia's finished #1 5 times, and we have finished #1 6 times. So again, hot stuff here in Utah. There's an inordinate amount of public developments going on. Here's a quick video to showcase 8 projects that are going on right now in our backyard along the Wasatch Front. Starting up north, West Davis Corridor. The US 89 expansion project. Of course, we've got the prison relocation. Airport expansion, can't wait for that to be done. The inland port's coming. Mountain View Corridor, infrastructure, heading further south, Point in the mountain, and the I-15 Tech Corridor. That's a lot of stuff going on in the public sector for construction. In the private sector, it's just as hot. I'll refer you back to your symposium magazine, but here's just 12 notable projects that are in the pipeline right now. Just those 12 projects, that's a partial list of development that's going on in the private sector, is adding over 20 million square feet to our base. And we need it. As my colleagues are going to talk about, we're absorbing this stuff, right, Andy? We are locking this stuff down, and so we need this. We're bringing 20 million square feet just in those 12 projects to the marketplace. What else is going up? Tax benefits are going up. We had the Tax Cut and Jobs Act that got passed in 2017. This was like a shot of adrenaline for our marketplace. We felt the effects of that in 2018. Now there's some things about opportunity zones, which is the part that I want to focus on for this presentation. Opportunity zones, to me, is a game changer. Now, there's things you got to be aware of. Number one, you can either invest in specific assets or in funds, so long as the funds have substantially all of their assets in opportunity zone locations. And over time, you got to double your basis. But this now provides a new avenue for tax deferral in our space. It's always been 1031s or pay your gain and sit it out. Now we have opportunity zones. Game changer. Not only can you eliminate or defer your gains from your sale, but if you hold a property for 10 years, your go-forward appreciation gets wiped out. That's a big deal for developers, right? Here's something I don't know that everybody's focused on, but in 1031s, you got to take the whole chunk of money forward, right? Debt, equity, everything, or it's boot. Any dollar you don't move forward. Not the case with opportunity zones. You only have to take the gain. So one of the issues that we've had as brokers is, guys, we come to them with a great offer. They're like, I'd love to sell, Bryce. That's a great offer, but where am I going to put the money? I got to turn around and be a buyer into the same market that I was convinced to be a seller into. And I'd like to be a seller, but I'm now a price taker, and I'm one of your DMV guys. And worse than that, I'm on the clock. I got to identify. I got to transact. Now you can take just the gain into an opportunity zone and take the basis, put that in your pocket. It's hard to time a market. This allows somebody to take their basis, take it back to dry powder, and time the market. That, to me, is really compelling. There's no 45-day ID period, so you don't have the gun to your head to make a poor choice. Now, I will say this. Anytime the government intervenes in private affairs, there's winners and losers, and what I like to call the law of unintended consequences. The issue here is, imagine you just bought an industrial piece of ground in the Northwest Quadrant in 2016. Market's hot, you paid up, but hey, you're bullish, you got to get some product up. Everybody now can buy a tract of land in your submarket and have an adjusted tax basis that's more competitive than yours. That's not great, right? If you're the guy that went out and bought that land in 2016. You've got now competitors coming in with a whole different basis. You've also got, every one of these opportunity zones has a start and a stop point. And if you're on this side of the line, you get great tax treatment. And if you're across the street, you don't. You have a competitive disadvantage. I have some equity in a shopping center in the marketplace. And of the four corners, we're on the corner of an opportunity zone. Thank you, Governor Herbert. The other three corners don't have it. We just got given money because of this legislation. We didn't do anything. And honestly, our corner is no different than the other three corners. We just happen to be hooked into the opportunity zone. So that's pretty cool. What's going on nationally? National sales market was up 10%, so nowhere near our 44%. We kicked butt compared to the national landscape, but it was also very dynamic as foreign sovereign funds bet on U.S.-backed real estate. There were 4 countries that each did more than $500 million: Canada, Germany, China, Singapore. Everybody wants to ask us what's going on with cap rates, and we want to tell you. But before I get into the cap rate discussion, I do want to, quick little soapbox, and that is, cap rate is a data point in time, right? It's one metric, it's one filter for how we look at real estate and prices and valuations, but it's really incomplete. At Newmark, we've tried to train our agents to advise people on a lot of other things, like what's going on in the submarket, what's the property's location and fundamentals from a functionality standpoint. How defensible is the rent stream? Is the rent that's in place that's driving to the cap rate above, below, or at market? Does it have bumps? Is there assumable debt? How good is the tenant credit? Can there be additional supply created in that submarket? Is there deferred maintenance? All of these things are really what goes into real estate valuation, but I feel like as a market, we sometimes obsess over the cap rate. But I digress. if we're going to talk about cap rates, let's do it in 3 different lenses. Everybody's been to the ophthalmologist? Get the different lenses, Chris, right? Okay, so lens number 1 is, as a data point, we need to compare cap rates to themselves over time. Data point number 2 for me is I like to compare our cap rates versus competitive real estate markets in our region. And the third is, as an asset class in real estate, we're competing for capital with other asset classes. And so what's going on with the yields in other asset classes, and how does that compare with what's going on to yields in Utah? That's the way we're going to look at cap rates. Let's start with comparing them over time. Again, check your magazine to break this down closely, but you can just see the macro trend is compression of cap rates. Investors willing to take less yield. That's what's happening because they continue to bet on all the great things that we've been talking about that are going up. We went down 33 basis points as a marketplace in Utah for an average cap rate of 6.31%. Now, that gets weighted down because of the rock stars like Raleigh and multifamily that are selling all this multifamily stuff at an average clip of 5.25. Industrial average cap rates were right there about 6.7%, dropped significantly from 2017. Office, for the first time ever, breached the 7% cap rate mark on an average basis, and retail stayed strong. How do our cap rates compare to other competing markets? The primary markets, that's your LAs, your Seattles, your San Franciscos. We don't compete head up with them for capital much, but it's a good relative comparison. The secondary markets is kind of our lane. And right now, as a marketplace, we're trading basically on par with other secondary markets in our region. Industrial is interesting because we have an 80 basis point arbitrage, more available yield here on average. I think that continues to narrow this year. And there were some deals that traded that kind of weighted that up more than it really should be, just a subset of the data. Retail's got a 30 basis point delta, and multifamily, this is the first time I've ever seen, I've been tracking cap rates for 20 years, I've never seen a category of properties in Utah trade at a premium to our peers in our region. That happened with multifamily this year. We are 30 basis points more expensive from a yield basis. Remember that population graph that we talked about? The country's onto us. They know what's going on here, and they're betting on our multifamily market. Third lens is what's going on in other asset classes. To invest in stocks, as noted by the S&P, at the beginning of the year, investors were willing to take a 1.84% yield. By the end of the year, that had risen to 1.99%. They need more yield to buy stocks. What about investment-grade bonds? Started the year at 4.2% yield, ended the year at 5.14%. That's based on the Moody's. That's a 22% required higher yield to invest in bonds. Money markets, because of the Fed tightening program, that went 18 times higher throughout the year. If you compare it to December of 2017. And even the Treasury, 9.3% higher. I think this morning it's trading just above 2.7. So in every other yield-based asset class, investors said, I need more yield to buy you. Real estate, they said, I can take less yield to buy you. So how long can that continue? I'm not sure, but it's a very interesting way to look at cap rates. So we're talking about all the money that's getting spent here in Utah. Where's it coming from? For the first time ever, organic capital was not the number one source for our investment transactions. We had 84 deals that were acquired in 2018 by California-based entities. I call it the jet stream of capital that's coming up from the south. California has discovered us en masse, and as I often tell my seller clients like Jono, pay attention. I know you're busy. Get off that phone. I said, Jono, I've got a California 1031 buyer. You gotta sell, right? That's our calling card. When my seller clients have got an asset, maybe they don't even want to sell, I pick up the phone and said, I got a California 1031 buyer. They're like, all right, send me the offer. So we've got Utah, $739 million was spent here. And even states like Texas and New York spent over $200 million on Utah real estate. Singapore had a direct investment into Utah as part of the Exeter portfolio. So this market feels a lot like we're at a craps table, right, Greg Ratliff? And we got a hot dice roll, and everybody's high-fiving, making money, having fun. And we don't want that to cool off, right? And this is a picture of our Fed chairman, Jerome Powell. And Jerome Powell right now, I think, is walking a tightrope.
Hand in my hand, and we promise to never let go. We're walking a tightrope.
The tightrope's tough. If we don't tighten interest rates, we create asset pricing bubbles. And we don't want that. That was painful, right? Last time we had bubbles. But as we increase the cost of money, refinance gets more expensive, construction gets more expensive, returns on equity gets tighter. And so if he tightens too much too fast, we create our own diffuse of the good times. And so I'm hoping that we don't have a sequel to this indie film called The Cooler, in which Chairman Powell gets cast as the William H. Macy character. The Cooler.
You know what I do at the Shangri-La?
You're cooler. You turn winners into losers.
Some people are born lucky.
Yes, yes, yes. Tell Bernie to get over to table 6.
Bernie is not one of them.
People get next to me, their luck turns.
This is one of your coolers?
He's the best.
Better luck next time.
Better luck next time. He's the Cooler. I love it. Just a Debbie Downer. So hopefully our fine Fed chairman doesn't turn out in history to be the Cooler of what has been an incredible run of our marketplace. I want to focus on this slide for a minute as we talk about, now before I go into my forecast, you should all know I'm a bull. I'm an optimist by nature, and the good times are going to keep rolling. We're going to be just fine here in Utah. We're going to have a great year in 2019, but I think it's fair as we talk about how everything is awesome and we're so great, that we also talk about what are some challenges that are out there that we need to be aware of and potentially mitigate. And some of these things are not in our control, but I call this the spread, and it's something I watch carefully. This is going back the last 5 years. This is the difference between average cap rates and the U.S. 10-year Treasury, which is a proxy for the cost of debt. A lot of debt is, quote, based on a spread against the 10-year Treasury. That spread's really important for investors to hit their return metrics that they need. In 2014, it was 474 basis points, the difference between cap rates and Treasuries. As you can see, every year since, that spread's tightening, right? What does that mean? Can that continue to tighten? It means the cost of money is going up and investors are taking less equity return. So it's going to be interesting to watch this slide next year and the year after to see what happens, because we're down to 362. That's not a lot of room for error for underwriting. That means rents got to continue to grow. That means interest rates can't go much higher, or cap rates start to have that upward pressure. That's what's going on in the spread. Some other headwinds I think we should make note of is just general volatility. For the first time since 2008, the stock market posted a negative year. We were down about 5% in the equity markets, and 15% of that was in December, in part because of the whole Federal Reserve talk that put a shock across the market, and he got scolded by our president. The U.S. equity markets, last time we had a negative year was 2008. We were down 37%. So we didn't have that kind of a year, but we were down this year. Something to watch for, because that matriculates its way into real estate decision and risk premiums. So now bear in mind the Case-Shiller National Housing Index was up 5% this year, but there's a sector fund that bets on publicly traded home builders and other people that track the housing market. That sector could be a canary in the coal mine as people discounted future earnings in the housing-related stocks, and that index, that sector fund, was down 24% as investors started to say the future of the housing market may have some cooling. Interesting metric. There's the natural diminishing effects of the tax and government spending that happened. And a couple other things I'm watching here is consumer confidence pivoted in April, went negative for the first time, and has continued to trail off through the year. That started in April 2018. And the level of debt in the economy is disturbing. Consumer debt, corporate debt, it was so cheap, right? Corporations loaded up on cheap and available debt. And as a country, we're on the debt juice. As a percentage of GDP, in 2008, our national deficit was 68% of GDP. Now, what does that mean? Well, it's a big number against a big number. But just on a relative basis, in 2019, we're going to go from 68% of GDP to a national debt that is 108% of GDP. That doesn't leave a lot of margin for error. So I'm not loving the debt levels. There's trouble abroad. Economies like Italy are struggling, and they're slowing in the Eurozone. Brexit drama. China, we have trade wars, economic slowing, tariffs. That doesn't directly affect it, but the totality of it could cool off the marketplace. And then there's lots of ships in D.C. There is lots of ships in D.C. We got partisanship, we got gamesmanship, we got brinksmanship. And right now, we got a government that's shut down, right? That's not good for productivity. That's not good for confidence. I've got 2 deals right now in escrow that we're having to get extensions because we can't get, in one case, the SBA to respond to us, and in the other case, we can't get a government award. And so we got deals in limbo. That's not good for productivity as a country. We got to get that figured out. So I'm not a 49ers fan, but I love what Jim Harbaugh, his theme was a few years back as the 49ers coach. Let's listen to Jim Harbaugh, because I am now getting into the forecast, and I'm going to wrap this up. And Jim Harbaugh says it really well.
We got to keep going, keep fighting, keep working hard every week, man. Every week. Let's go, baby.
Hey, one last thing. Let's break it down. Huh? Let's break it down. Now listen. Okay, you did a great job. Took care of goal number 1. Now we got a lot more to go. Yeah. Let's move on with humble hearts. Got to work. That's what we believe in, all right? Yeah. You know the question. Who's got it better than us? Nobody!
In this market, who's got it better than us, Corey Moore? Nobody, right? This is awesome. Let's move forward with humble hearts. Let's not get too full of ourselves. Let's stay bridled in our development. Let's be giving back to charity. Spend time with your families. Wake up every day with gratitude in our hearts for how good of a role we've got. In the history of the world, who's got it better than us? I think nobody. I see cap rates towards the end of the year leveling off, maybe even starting to inch higher, except in the industrial sector. In terms of volumes, we're going to have another great year of volumes. I don't know that we'll do $3.18 billion again, but we're going to have a very robust marketplace from a volume standpoint. But I think some of those headwinds might slow us just a titch in volumes. Industrial stays really hot. Retail, kind of tale of 2 cities. The net lease sector is pretty bulletproof as we have baby boomers seeking income yield with tax benefits and some rent growth rather than bonds. In the general retail sector, Andy Moffitt, I'll leave this to Andy to talk to you about kind of the important things. There's some caution there, but retail's still relevant. It's just evolving. And now what we're counseling our clients is don't just underwrite the shopping center from a real estate and ROI standpoint, but you got to kind of underwrite the business models of your tenants and making sure they're not being victims of the Amazonian nature of the market. But things like grocery, location-based entertainment, service retail, those are all things that are holding up strong in the retail sector. In office, steady as she goes. We see, because of that job growth number and the population growth, we see so much outside capital still saying, boy, Utah's a great place for us to own office properties. And the developers continue to give us great supply, so thank you to the developer community out there. In summary, we're going to have opportunity knocking. 2019 is going to be seen as a market that was a great time to be a seller. There's lots of value still to find as a buyer. At Newmark, we're available for you at any point in time. We love to advise our clients. Any of the slides that you found of interest today, or you want to have a conversation about any of this stuff, hit me up. Really love what we're doing in Utah. Love the market participants in this room. It's so fun to be part of a symposium like this with friends and colleagues. And wish you well the rest of the day and in 2019. Thanks, everybody.